Hope you're well.
All good.
Radhika, Akshay, is our voice clear?
Yes, it is.
Okay, perfect.
So we'll just start in the next 3 minutes, I guess. Let's wait for the next 3 minutes for people to join. So a very good morning to everyone and thank you for joining us. So today we have Mr. Yatin Desai, Group Treasury Head of Zydus Group joining us. With nearly 19 years of experience in the treasury space, Yatin's expertise is unparalleled. He has been an integral part of shaping the treasury team at Zydus since he joined the company 16 years ago. Notably, the Zydus Group is a prominent pharmaceutical company with a remarkable 60-year legacy, and they have about 17 crore plus annual revenue. So please join me in giving a warm welcome to Mr. Yatin Desai. Welcome, Yatin. Glad to have you on board.
Thank you.
Also, we have Ankur Bageria with us. He's the CEO and founder of CashFlo. Before CashFlo, he was with the Boston Consulting Group. CashFlo also has its dynamic vendor financing product suite, wherein CashFlo aim to help optimizing working capital while increasing treasury returns or extending payable days. So we are very excited to hear about Ankur's deep expertise on the very product. And I would now like to hand over the stage to Ankur and Yatin. Also would like to mention that you please feel free to post any questions in the Q&A box so that we can address those at the end of the session. Over to you, Ankur, now.
Yeah, thank you so much, Radhika. Yatin, great to have you here for this session today. So thank you for taking our time. It's always a pleasure to hear from from you on your thoughts with regards to topic and corporate finance in general. So very excited to explore this topic of treasury optimization and dynamic discounting. So let me actually start off with asking you about how the role of treasury at Zydus has evolved over these years. What has been the journey over the last 5 years, and what have been the key priorities for corporate treasury, and then we can sort of go from there.
Firstly, morning to everybody, and thank you, Ankur, for this opportunity. So I think giving a background about Zydus Treasury, I think if we see 5 years back, close to 2019, our debt has soared to close to 8,000 crores, if I talk about, numbers. And, cash position of around, 1,200 or so odd crores. I think the typical mindset was always in terms of optimizing the surplus, in terms of how we are retaining cash in the books, how we are able to invest those and generate returns out of it by way of deploying funds into deposits or any of the revenues. Typically, treasury is always a mindset about how to source fund, how to deploy it for shorter tenors or the longer tenors, as the case may be. I think from there, if I see last 5 years, I think we have conventionally moved the approach from pure play treasury. Now it's now into a business support approach. So rather, we are now helping businesses to take decisions in terms of their approaches, how they see the business, how they want to mitigate their requirements. And while we talk about it, then we have to go with unconventional approaches. So typically, we always think about how do we want to deploy funds. So businesses have their requirements, they have their own time gaps to mitigate. How do we mitigate this? How do we ensure that the costs are remaining at a low levels? How are we ensuring our cash conversion cycles are improving? So this is where we sit with businesses and try to maximize to an extent possible. So over a period of last 5 years, we could see that from the thought process of just managing those short days to a longer approach of how do we maximize the relationships with businesses, with our entire ecosystems. How do we feed them with their support requirements? That's what the thought process has changed over a period of time.
And we have a lot of companies in India that might not be always sitting on surplus treasuries, large surplus treasuries, but often also are sitting on unutilized cash credit lines or OD facilities. Do you feel like Treasury can play a role even in such situations? And what are some of the key levers available for Treasury organization today for cash-rich companies as well as that are perhaps sitting on unutilized CC lines?
Good that you brought this point. I think it's important to understand that not everybody has a cash to sit on. So I think, as you rightly pointed, most of the businesses which we interact are largely in terms of they have some CC limits available with them. They have some overdraft facilities we are available, though they are not utilizing effectively, but they have those surpluses available with them. And I think we, as an investment avenues or treasuries, what we think is that we always see the risk and return parameters, which are important to make decisions in terms of how to deploy funds, how to borrow funds as well. Now, if a companies which have a surplus balances in their limits or sanction limits, I think typically mindset is that we would like to utilize only when it is required. Otherwise, we will sit on a whatever is available cash, right? Other alternatives that start utilizing those limits and help your suppliers if they need funding in advance. Thereby, what happens is that you are doing two activities. One is helping them to grow their business, and also ensuring that you are optimizing whatever sanction limits available with them. There's no banks, at least on a mid or small segment sort of sanctions. There's somewhere or the other they keep charging you one sanction fees every year. They will levy some or the other charges. So how to ensure that you are coming out of it? So I think this is very interesting avenue.
And this I'm sure companies would have explored these kind of opportunities directly as well, right? Where a lot of companies we've seen have cash discount policies that run with their suppliers from time to time. What are in your experience, what have been some of the challenges with early payments to suppliers, and where do companies run into challenges?
So I think the first thing comes from our purchase department is that if you do this, the price will start increasing. The supplier will increase the prices in the next 3 months or 6 months. They see the liquidity, but that's just people had been following up over the period, and that's what we also experience in our journey to bring the organization to these levels. So what happens is that typically mindset is that my supplier will increase the price, and people don't realize. However, the markets have not been 1980s market where you have only one or two people who are doing this business. There are hundreds of people doing the same business. I think price check is done every year by everybody, and this is always important for larger business as well as small business. I think smaller business have a better control as compared to larger business, because you have limited people and you interact with various avenue or alternates available as a the price discovery in terms of what is a market price for certain items procured. So I think that stigma is always taken care when you start doing RFQs across various people. RFQ, I mean, it's a fancy word to say in terms of larger business, but smaller business, they take a phone and call 2-3 companies that you supply this. If I would like to place an order, what is going to be minimum order size and what is going to be my price? What are the terms which you offer? So I think this is where the typical mindset happens, that price increase, but there are no price increase which we have witnessed over a period of last 3 to 4 years, where we had started moving this as a journey. The matter of fact is, this is a rather helping hand for our suppliers, because let us understand, it's like you grow, we grow sort of an approach. If your supplier is having order book with them, they are not asking you to increase price. They are saying that if I increase price, my turnover might get hampered. I may stick to 2 or 3, customers, and I will be continued. If they wanted to increase more revenue or more, business, they have to improve or be more competitive in terms of prices. So this helps them to get their cash early and make the payment and start more faster, business flows or rotations. That helps them to improve the cash conversion cycles.
Yeah, that's interesting, because we also, when we've been serving clients across industries now for nearly 5 years, and across large corporates, whether it's consumer goods, pharma, manufacturing, this has been a constant question that has come. What happens to our purchase prices? And I think some of this reservation we've seen come from how traditional vendor bill discounting has happened, where the lenders would lock in the supplier as a contract for, let's say, 12 months or so, where every invoice gets discounted at a certain fixed rate. Now, the reality in our experience has been that every business has peaks and troughs when it comes to working capital needs, and they don't always need the money, right? What they really need is flexibility in being able to get access to short-term credit as and when required. So if some new purchase order comes and they don't have liquidity at that point in time, that's where they'd want to avail of a facility, right? But they don't want to pay interest for every single invoice that gets raised. And because of that legacy way of vendor bill discounting, what would happen is the suppliers would then start baking in that price over time. And although and of course you're absolutely correct, purchase procurement teams anyway end up having multiple suppliers, but somewhere they for certain maybe raw material items or certain SKUs, suppliers would have tried to do this. But the marked shift that we have seen with the platform-based approach, at least at CashFlo, is that the suppliers are deciding when they want to discount, and it's a completely optional solution, right? So effectively, I will at a rate that he's not comfortable with, and he will only discount when he really needs the money, right? So that ensures that the suppliers are empowered to decide the rate as well as the timing of their discounts, which effectively actually reduces their cost structure. And as a result, even in our experience over these 5 years, we've never seen a single price increase actually take place across the supply chains we've been working with. In fact, if anything, relationships have only improved between the buyers and suppliers over time. So I think that's been one of the key insights even for us.
So to add to this point, I think a very important aspect that earlier used to be company used to run the cash discount program. By virtue that company used to have that control that to the suppliers. It is their discretion, their choice, whether they would like to opt or not. So it is something to do with, if they feel that their business is growing, they need money, they will use these platforms and get the money.
Yeah, I think that's and my personal view is that this is the future of how buyer-supplier relationships will evolve, and more and more large enterprises are seeing value of this, and gradually mid-market companies are also beginning to replicate these models in their own supply chains. And it becomes a great alternate avenue of liquidity in the market, beyond what banks and NBFCs are doing. It actually, one of the very interesting data points we had sort of come across was, across corporate India, there is north of $150 billion of cash that is either sitting in treasury or sitting in unutilized lines. And all of that is likely earning, sub 7 to 8% returns, right? Whereas, their own supplier base, oftentimes is borrowing from informal sources at rates as high as 24%. So there is this massive disparity in cost of capital, between buyers and suppliers, and, avenues and platforms that can allow, this exchange of liquidity at, at terms that are a win-win for both sides ends up making a massive impact to the economy over time.
I can't disagree on that point, and I completely buy your point in terms of, see, there is annually in terms of borrowing and investment rates, because bank sets on its own requirements to have minimum reserves built up as per the mandate of RBI. So they are borrowing or they are taking deposit at 7 or sub 7%. They are lending to a mid market or a small markets, where rather small suppliers or customers who are doing businesses, they rather have always a challenge to even procure funding. So as you pointed out, 20-24% is not something which I have it's unheard of. It's the reality.
Yeah,
this kind of platform at least try to bridge the gap, in terms of what treasuries or the surplus or the people who have unutilized limits. If they start looking at the limit, sort of, for the sanction letters, they might be having what 10, maybe higher of the 10 or 10.5% sort of borrowing cost, and they can help their suppliers by raising the funds for a very limited period, and are able to make good out of this to help your supplier. So they, rather from paying from 24%, they can come down to maybe 16% or 18%. At the same time, the bank borrowed money which is getting deployed is also fetching returns. So companies are not losing, but at the same time they are able to help their suppliers effectively.
Yeah, and the key aspect here, in our view, is that the rate finally should be in the supplier's control, right?
Correct.
The supplier should decide what is the best rate available to them, and finally, basis demand and supply, the equilibrium is reached. And those are, just like the stock market, that's, every supplier will find their optimal rate at which they can discount, right? So market forces sort of end up dictating what the right price should be, and that's generally how efficient markets run as well. So I think conceptually this tends to be fairly powerful. Yatin, I wanted to sort of take this one step further into talking about the practical aspects of implementing a solution of this nature, right? Would love to get your insights on what are some of the key concerns or considerations that every treasury head has to think about when they're implementing solutions of this kind. What was the journey at Zydus? Would love to get your insights on how you thought about it, for the benefit of the audience.
So I think we also being, evolving with the journey, I think we had done a pilot with, a couple of fintechs. So it's about 4 biggest fintechs in the India. So by virtue of that, what happens is that we are trying to understand the systems, how easy they are, how adaptive they are in terms of connecting with the various firms. So our suppliers can, work on various systems. So they might be on Tele, they might be on SAP, they might be on Oracles. Right. So what happens is that how these things are going to get, because spending extra time is a difficult task for ecosystem to build up. At Zydus end, we have those machineries to work with. However, what we wanted is, first is confidentiality of my data. Second is in terms of how dedicated the fintech companies are in terms of their growth trajectory. Third is in terms of how they are able to approach their customers or putting up milestones, how they will be achieving it. Fourth is in terms of how easy their systems are for somebody to operate, because something from our side, it's like for us it is easy to push the data, but while seeing this system and requesting for funding or understanding what is the math around it, I think it gets extremely important, and how easy for suppliers to use it to make it effective. So I think these are some of the critical aspects. I think fintech companies do come with solutions, but I think over a period of time, they lose the edge of ease of use. I think that is where the criticality comes. The moment you start getting easy for somebody to understand, even a very beginner or amateur can understand and start applying. I think that helps people to make use out of it in an effective way. So I think this is where it stands really good for us. I think it's very easy for us to use in terms of connectivities and everything. At the same time, I think a team who is working, I think they are dedicated and they are delivering as per the what we have agreed as a milestones in terms of how we are going to scale up, how we are able to build up the relationship with suppliers. And I think suppliers, we also got feedback from suppliers that how easy for you is to use these systems. Is that we got a feedback that it is very lucid to understand. It's very easy. There is no special, sort of an approach which is required. However, people are there to train them. So, fintech companies do invest in this, and I think what we got to feedback also for CashFlo is that their team is working extensively to make people understand how things are to be used for. It's not like I'm supposed to throw a video and help them to understand on their own, but apart from that, I think whatever problem solutions or queries, I think they are getting answered. So that helps them to use it effectively.
Yeah, I think, if I reflect back on our own journey, right, I think today we are probably at the, I think, 9th iteration of our vendor platform, and it's been a journey to sort of really understand how to make it as user-friendly as possible for, suppliers. And, you have to think of the smallest and the largest supplier, right? You have to think of, the one which may not be tech savvy and the ones which are very tech savvy. And so covering the entire gamut requires a fair bit of iteration over time. And you're absolutely right. I think the final proof of the pudding in adoption comes from, how well the platform works for the suppliers, not so much the buyers, right? Buyers are still fairly savvy, but it's the suppliers that need the support. And Yatin, from a implementation standpoint, right? Again, as a treasury head and as a finance function, what were some of the key decision factors that you evaluated? It will be useful if you could sort of give a broad framework to say here are the few areas that every treasury head or CFO can think about when evaluating solutions of this nature. When is it relevant for a company to do it, first of all? And secondly, if it is relevant, then how should they sort of evaluate what's the best fit?
So I think to address your questions in two phases. First is whether they should be on what size they should think of. I think there is no size restriction to my mind. I think I think we as an organization have the departments, we have people, dedicated team working on it. But I think ground reality is that people don't have those enough resources. I think 1 or 2% runs on their accounts, finance, banking, every activity. I think it becomes extremely difficult if somebody says that you have to now do an additional work. But if these platforms are able to integrate with Tele, so it's small ERP systems, Khata, everything. So that helps them at least to do their regular activities, and as a part of their small portion of their day, they're able to get use out of that. If I wanted to make use out of my requirements, or I would like to have some limits available for next 1 month, I can offer that to my suppliers, that if supplier comes up and says that I need funding, you can help them out. Apart from that, I think most critical parameters are in terms of as a treasury, what we see is that first is that dedication. That is very important to convert suppliers. So you want suppliers to come and participate, for them to see as a business prospects. We are using this tool to make it more connected. So how fintech companies are able to connect, how frequently they are able to connect, that is very important. Second aspect, yes, the commercials does play a card in terms of what is going to be that I'm going to pay extra. But I think that is something to do with our requirement that we are deploying funds at 7 or 8%, right, in a normal trajectory. Whatever alpha is coming, thanks to the solutions or the platforms which helps us, then we have to just see that what is a portion which I am shelling out and what is the extra I'm earning out of it. So the conventional thought process comes that I should be having an entire pie. Then are you ready to pay a fix, or do you go with a variable model, which is more simpler, that as and when we are able to generate income, you shell it out, right? third and foremost is in terms of the system integration requirement. And fourth and most is privacy or secrecy of the data. That is the utmost importance to us. I think, we would never like our data to be shared in terms of who is my, customer, where it is going, what price I'm purchasing. Nothing of this sort gets shared. So what we are sharing is a simple list of invoice, their due dates, their booking dates, and the amount. That's all we do. And that helps us to protect our privacy at a most in terms of the competitive world. This becomes a very important matter of concern for us.
Yeah, especially in pharma, right? I think and every industry, but in pharma in particular, we've seen that.
So competitive advantage is always important for us, and I think nobody would like to shell out what commercial somebody is doing sort of business. So nobody would like to shell that out.
That's right. And that's interesting. And, as far as, once, let's say, a company has decided that they want to pursue this, value proposition for their supply chain, when it comes to implementation, right, a lot of things can go wrong, right? Most technology solutions look great on paper, but oftentimes the real challenges start when you start getting into implementation. Would love to hear from you what's been your experience in implementing this solution for your supply chain. And, you talked about bandwidth, right? How much bandwidth is required to invest beyond the day-to-day? How much bandwidth does Zydus have to spend in running this, initiative for their suppliers? I would love to get some.
If I may quote within Zydus, I think we are spending maybe 1.5 hour, mandate for this purpose. It's hardly 1.5 hours. That's all. So once we have initially invested in terms of integrating, once the system integration takes place, I think it's not a matter of concern for us. It flows so very smoothly, and it becomes very important for every business to see that their resources are optimized rather than putting up extra resource for this purpose. Why not existing resources can work on it? And I think now the technology era is already in place. You can make use out of the technology, and I think thanks to you guys, you are always investing in terms of technology which is easing the operation. So it's like I'm in a way enabling additional resource in my system to make use out of these activities. That makes sense for us. I think that's integration perspective, I think, or how it has slowed down. So the second important thing is the communication which goes from the company to their suppliers, that yes, this kind of program which we have put in place, which helps suppliers to know whether that is genuine or not. I think that also has been an initial phase in which I think we had been getting feedback that we have received email from their side. I think if the company is also confirming, and through mail confirmation, and that team or the purchase people who were handling that, they were fully onboarded in terms of what is the program which we are rolling out, what kind of data it is going to flow to them, what is visible to them, what they need information. I think at times we have we have received feedback, rather people have started using this platform as also reconciliation tool. So they see that their list of invoices showed us X, and they have another 20 invoices. They will come back and say, "Sir, we have another 20 invoices. Can you look at them as well?" So I think this kind of engagement becomes important, that it keeps repeat usage of the platform takes place. And I think why we say platform is important is, I think conventional ways that I can think of putting up on my own, but I don't have resources to be spread around. And I think this is what you guys are good at. So why even you are supposed to deploy any resource for this purpose?
And Yatin, what's been your experience from after having run this program for some time now? I think over 2 years probably. What have you heard from suppliers? How has it helped you in terms of relationships with suppliers? Any thoughts on that?
So I think a couple of points which I would like to share. I think this has helped in terms of the supplier systems to cool down in terms of their requirements, funding requirements. We had been abruptly receiving mails from the suppliers in terms of they need some funding, and I think that gets diluted in the system because of the huge organizational structures which we have. I think this has helped all those suppliers in terms of their growing requirements. So that has helped in one way. Second is in terms of suppliers are able to rely on this platform, that whenever they need some sort of funding, they can come to, right? It's a go-to solution for them, and which helps them to make use out of, or rather, keep on looking for more and more business.
Yeah.
Third is in terms of the stickiness. So supplier, with these programs put in place, suppliers also entrust us with the more business because they see that, I think if Zydus has a X payment terms, but if we want some money extra, I think this is the, through this platform, we are able to get those money to run my operations. I think there can be a crisis situation at the other end, or there can be a new business, which can be a, a matter of concern. I think that helps them a lot. And further and foremost, I think that has over a period of time educated our suppliers that how they are able to get a hands-on, in terms of the growing relationship with the Zydus, as well as how they can engage. So now they are started talking about if they have some other suppliers which are their other customers. I think they are also requesting that how we can bring them on a this C2FO platform also. So I think this becomes an interesting way that they have started understanding this is the channel to do business.
Yeah, no, absolutely. And I think, one of the sort of insights we had also received from a lot of suppliers was, oftentimes in, traditional vendor bill discounting programs, the top 50 odd suppliers would get covered, top 100 suppliers would get covered. But a lot of the smaller suppliers would never get access to those kind of programs because, practically it was hard for even lenders to reach out to every single, SME supplier, right? And this platform in a way ends up, democratizing that access to credit for, the smallest suppliers as well, and treats them at par with the larger suppliers. So a lot of suppliers we've seen who don't have strong enough credit or don't have, let's say, collaterals to put up to get access to bank credit, here, because they don't need any credit history as well, they can actually just with one click get access to funding. So that certainly ends up strengthening relationships in our view with buyers, right? And that is actually invaluable beyond whatever financial benefits might accrue to both sides. I think the relationship aspect is often overlooked, but very critical.
So I think that's important in the longer term sustainability. I think, in a larger organizations, I think ESG is becoming very crucial part of it. And I think, your suppliers are part of your ecosystems where you do have a sustainable relationship with them. I think sustainability comes with 2 or 3 things. One is in terms of your constant engagement. Second is in terms of how well you both are connected, and third is that how you can meet each other's requirement. I think in we many times we see that we go to supply that we need a urgent delivery of the order because of some good orders have come up. So I think that's where we ask their support. I think in term at times when supplier needs those kind of funding, I think that is where we have to also stand by this.
Yes.
And as you pointed out, I think the filter happens that top notch gets the whatever support, but I think bottom out is a problem. I think fintech does not put any barrier in terms of what is a size, big or small. I think for them everybody is coming at a same level, and that is why they are able to generate more and more engagements.
Yeah, no, absolutely. And I think we're, just in the interest of time, I will, perhaps pause here. I think we've covered the whole host of, aspects right from the value proposition and how it can help corporate treasuries optimize returns and help their supply chains to actually some of the implementation challenges. So thank you so much, Yatin, for being candid with your insights and talking about, some of these solutions. At this point, we'll maybe pause and open up to the audience to ask questions. I believe we already have a few questions coming in, so perhaps we can spend the next few minutes answering them.
Yeah, so I'll be unmuting the people who've asked the questions. So one question that we have is that how is it risk free, and how do we ensure that we'll get like at least 12% returns on our investment? I think Ankur, I would like you to answer this. Would you like to take this over?
Sure. So, I think the way the product is structured and the platform is structured is that, for the buyer treasury, they can essentially put up invoices for discounting once they have been approved on their platform on the buyer side. So once the QC has been completed and the finance has checked the invoices and booked the liability in their system, that's when these invoices become available for suppliers to discount. So in a way, and oftentimes, credit period vary from 30 days to 45 days to even, beyond. The suppliers get opportunity to, seek early payments against those invoices. And for the buyer, because that, effectively, they've already approved this in their system, it becomes a risk-free deployment where they can capture some arbitrage in the process. So that's how it ends up being risk-free for the buyer.
So I'll add to what Ankur is mentioning, is that you get goods delivered, right? And when you get goods delivered, what is the insecurity in terms of shelling out this money? I think if you have a credit terms, let's say taking an example of 60 days credit terms, you have invoice which was issued at 1st of August, and you have payment terms of 60 days. Today, if your supplier comes and says that please discount this invoice, for you, what is the risk? The risk is whether goods have been received. The answer is if the goods have been received. I think you have no risk. You are not running a credit risk. You are not running any settlement risk, because in any case this is your payment which you need to make payment. Rather, they are running risk on you that on 60th day whether the money is going to come or not. So in this way, for treasuries, this is risk-free investments. Quality parameters, I think companies do. As a pharma companies, we have those quality parameters which are critical. So till the time quality release does not happen, we don't allow the money to be discounted, because that puts up the perspective. It's something to do with our governance practices. So the moment your quality release is through, so I think your material is good to be consumed, right? Then what is the risk lying in this early payment? Zero.
Right. Thanks, Yatin and Ankur, for the insights. So next up, the question is more for you, Yatin, which is what is the feedback that you're hearing from vendors about cash flow?
So I think what we are getting, feedbacks or vendors had been, so we started with the pilot where we had talked about what, first, month, I think we were at what, 25, 30 vendors, right? And we are now into 3-digit vendors which are participating on the platform on a regular basis. So I think the engagement is important on from fintech side. From our side is that we support fintech in terms of, so there are two kinds of solutions which are available on fintech. Either you go for a bank financing which are linked on the platform, or you go with the treasury surplus, right? So we are able to make use out of it, and suppliers are able to come back on the platform and keep looking for the funding requirements if they have. It's absolutely in their discretion. So they find it more effective because they are more empowered, rather than we saying that we will give you X or you will give you Y. They say that I want only Y. You please give me Y, and that is being sorted.
Got it. Thanks, Yatin. So next up, we have, do you see Treasury as a strategic function? With this program, are you also recognized as a revenue function too?
I think revenue function is a very broad aspect. I think what we are trying to see is that is the intent of these to make money only? The answer would be, if the answer is yes, then it's a profit center. But if the answer is no, it's not the only objective. The objective is that I have to have a sustained relationship with supplier. and I have to ensure that my supplier, I stand by my supplier at every point of time. At the same time, I am also making best out of whatever is available with me. If I have a funding limits available with me, I should make my best out of this for my organization. At the same time, if I have surplus, I have to deploy surplus in the most effective way. So in that case, my intention is to optimize, but I am not running as a profit center. No, that's not the intent.
Got it. Got it. The next question that we have is from Mr. Anup Lalwani. I would like to unmute Mr. Anup so that he can answer his question himself. He can ask his question himself. So okay, so I think Mr. Anup has not been able to attend the webinar till yet. So I'll ask the question myself, which is first question is that can we get the webinar recording? So I would like to answer that. Yes, we'll share the webinar recording with every attendee after the webinar is over. Secondly, the question is that can we get cash flow company last 3-year financials? So I would like Akshay or Ankur to take this question.
Yeah, I think I mean we can get in touch with Mr. Anup later, right? I think we've heard this question before, right? Like when we try to get in conversations with buyers, they typically want to get an idea of whether cash flow is a reliable legit company. They also want, I mean, apart from like financials, which we can like discuss offline, just to give you a sense of like the kind of clients that we are working with today, just to sort of, establish some reliability and to also give you a sense of, the kind of corporates that we are working with today. Maybe I'll hand it over to Ankur and he can talk about like the number of clients or the kind of clients that we are working with and who are the logos that we are working with today, right? So, yeah, Ankur, do you want to take this?
Sure. I mean, a lot of it is already public on our website, but I'll keep this short. Today we work with nearly 100 odd corporates across about 12 odd sectors, serving their supply chains, and we've been doing this for nearly 5 years now. We have an extensive network of north of 2 lakh SMEs and suppliers which have access to discounting their receivables on a need basis. Fundamentally what we've seen is that there has been a generally a very strong acceptance in the market for solutions of this nature, and we've been very fortunate to have that support coming in from enterprises across industries. In pharma in particular, we've seen that pharma companies have seen a lot of benefit leveraging platform that we provide. I think happy to discuss this more in detail. But I think as it stands today, we're one of the leaders when it comes to providing vendor financing to supply chains across Indian corporates.
Super. Yeah. Radhika, over to you. Do you want to ask the next question?
Thanks, Akshay. Thanks, Ankur. We'll reach out to Mr. Anup separately. Next question we have is from Mr. Lokesh Raj. So I'll just unmute Mr. Lokesh so that he can ask this question himself.
Yeah. Hello.
Hello. Yes, Mr. Lokesh, you're audible.
Yeah. So I have been listening to this session. Once it appears to be a very nice software tool. So I work with businesses to maximize their profits and all. So I feel that this risk-free money that they can make can actually help businesses. So I see that it is similar to TRED's platform, trade receivable discounting. So I see that this can also be a TRED's platform. Why we are not going in the direction? We are focusing on payables only, and then how else can people benefit from this cash flow platform?
Sure. Perhaps I can take a stab at it. So look, I think it's fundamentally the idea is to help SMEs get access to working capital. And this platform is one of the avenues for these SMEs to get access to working capital by leveraging their receivables against corporates. So it's not very different from a trades platform. We as CashFlow also work with multiple lenders in the market. We have corporate treasury as one of the funding sources. We have about 20 odd lenders, banks and NBFCs as funding sources. So in a sense, for a supplier, for an SME, it becomes a marketplace where they get access to working capital whenever they need it, irrespective of who the lender is, and they get it at their own terms, right, which is the most important aspect. So while we're not regulated much like the trades platforms, but we are a technology solution that ends up helping the suppliers in the same way that a trades platform would. So that's how we look at this opportunity. And to your second part of your question on how CashFlow can help beyond this particular use case, we also help businesses both large and small to digitize their finance function. We have a SaaS offering that enables companies to automate their entire accounts payables process end to end, and we are probably the only company today that in India that allows customers to not just digitize their processes but also run vendor financing through the same platform.
Fantastic. Thanks, Ankur, for that. I think we have a couple more questions. I'm just going to run through a couple of them. Lokesh, we can also connect offline, right? Like after the webinar, we'll be in touch with you. And if you have more questions, we can always address them. In the interest of time, and we have a lot of questions, I'm just going to go through them at this point of time. I think we have one question from Ankita Chavan. Radhika, do you want to unmute maybe Ankita, and then you can ask the question themselves, right?
Hi, am I audible?
Yes.
Yes.
Yes. So, hi, Ankur and Yatin. My question was, how can we encourage large corporates to, sort of participate in our programs? Like any key pointers with your perspective that we can give them?
Yatin, you want to take this?
Yeah, I'll take this. I think a very interesting question, and this is where we have to play, a wild card. So what happens is that typically, big corporates have their access to, funding requirements. So I think they are never short of their funds in terms of, sanction limits from various banks to do their business. Now, if you wanted to bring out bigger corporates, I think that is where you have to come to actual market rates. So while we are talking about big double-digit sort of returns, in terms of discounting and everything, big corporates does not sell it out. But the moment you start coming close to the working capital plus 50 bips or 75 bips, I think this is where you are going to play a card with them in terms of their participation. And second and foremost comes is in terms of their balance sheet management. I think big corporates are always sensitive to their balance sheet dates. And this is where they are, getting active. So typically, if you talk about lever, I think that's where you actually come to a market. So it's like you replace, your investment avenues with your big corporates. As simple as that. 50 bips, 70 bips, plus. I think they are okay to accept it because this is without any collateral. This is without any security requirements. Nothing of procedural aspect where they are supposed to engage into. So this is how we see the participation increase the moment we start talking about those rates.
Yeah, and just to add to what Yatin was saying, one of the use cases for larger suppliers we've seen is that often during quarter ends, annual year ending, they use this as a way to optimize their own balance sheet by reducing the receivables on their balance sheet. So it becomes a great balance sheet management tool for larger suppliers, which are listed.
Super. Thanks a lot, Yatin and Ankur. I'll move on to the next question. In the interest of time, we won't take any cross questioning right now. Again, we can connect offline and discuss further. Thanks, Ankita, as well. There's a question from Jyoti. What is the security and collateral that's required on the seller or buyer side to come onto this portal? And then there's a request to share the technical PPT for the management, for the supplier and IT team. I think the second one, we can maybe take up offline, Jyoti, after this. And the first question, I think Yatin already touched upon it a little bit, that there is no collateral as such, but maybe I'll pose this question to Ankur and Yatin again, right, and they can take it up.
So I think for the suppliers, I think there are no collaterals except your invoice is your collateral. If your invoice is there, you are able to get those discountings put in place. There are no cash collaterals, there are no securities, there are nothing of those sort of documentation gets anywhere. All you have to do is execute your documentation with the fintech in terms of your participation that you would like to opt for, on a regular basis, you would like to participate, and that's all.
Yeah, also, just to add to Yatin, there are actually, for a supplier, there is no documentation either, right? So no KYC required, nothing. It's literally, one click and done, right? And that's how seamless it is. We've seen suppliers start availing of credit within minutes of enabling the platform. So it's extremely seamless, no physical documentation involved.
Okay, thanks, Ankur. So I'll move on to the next question. So it's from an anonymous attendee. While implementing such platforms, do senior stakeholders face challenges in terms of human resistance from team members, treasury, ops, etc.? Since this adds additional work in their daily routine to log onto a platform and say approve invoices, right? So how do people manage such human resistance from team members? So Yatin, Ankur, I would just
I think human resistance to do something, any change is always there. So that's very valid question, and I think that is a point where we as a treasury guys are sitting in and working with each stakeholder just to make them understand that what is the process all about. And additionally, we take help from cash flow, or for that matter other partners to help businesses digitize. So the moment you start digitizing businesses, I think that is where you just see yourself as faster process. And like I say that while we are running few hundred crore program on a monthly basis, what happens is that what is important for us is to see is that the hardly 1.5 hour of the entire month gets consumed for this purpose. And this is where it especially gets digested. The moment people initially, without knowing, they will start jumping in terms of this is an additional work. But the moment you start exploring in terms of digitizing this entire process, I think there is no human intervention or manual efforts which will be required. All you have to just go is that you decide your data are already pushed in terms of your invoice list. Your invoice lists are already the C2FO cash flow team is working along with you in terms of how you are pushing to your suppliers that this have data available. If you want to discount, please come on the platform. And especially in terms of what we have done is with the cash flow is that we have, I think, kept twice a week sort of arrangement. So by virtue of that, what happens is that people are able to come and visit their invoices every 2 days, and this data is getting pushed from our system. So there is no manual effort required for pushing this data. So nobody is engaged in terms of these activities. And while the data is received from the fintech company, I think what we see on the cash flow platform is that what are the list of invoices which we have already approached for the discounting. All we have to see is that if we are okay with the financing, if you have surplus fund, you say that select the people with the surplus fund requirement and you approve it. That's all. Nothing extra effort. Even for that matter, we have done an automation, and something which we are doing is auto accountings, which are also being put the moment the success takes place in terms of payment. I think then there are even accountings are also being automated. So that in a way takes care of the entire requirement of people or man works, then it's hardly 1.5 hour a month. I think that's something which is easy to share. I think that is where we have to work closely with each team to make them understand what is going to be their role, and that is where the communication becomes very critical. You have to go with your purchase department, what is going to be your role in terms of, are there any disputes? So you have to get into in discussion with them. If there are disputes with certain parties, you don't want them to, then you let us know. We have to ask them that you please have the disputes addressed, right? So that helps in terms of creating two-way communication rather than just one-way monologue that this is not to be done.
Yeah, and if I may just add, in actually this helps in reducing the workload of finance teams, especially around reconciliations. So, over the last couple of years, what we've seen is that traditionally, if they were running cash discounting programs or just generally vendor payments, they would have to, once they make the payment, they'd go back into their ERP and manually update the fact that a payment has been made. They would open their bank statement, look at the narration, find the invoice against which the payment was made, put that UTR back into their ERP. All of that is a manual process, and that actually consumes a lot of time. But by using a platform of this nature, companies and their accounts payables teams have dramatically been able to reduce their time required for payments and reconciliations and running cash discount programs. So actually, this ends up reducing workload instead of increasing workload.
And I think to add to what Ankur is mentioning, I think that's also one more solution which is being rolled out by CashFlo is in terms of payment digitalization, by which they are moving. So if let's say, taking an example, I have approved 15 crore vendor discounting today and I have one fund. I just need to do one fund transfer to CashFlow account, and they have this escrow mechanism which is in place, which is approved by RBI as well. So by virtue of that, with single payment to CashFlow, they will be paying to the various suppliers. They will back push your system that this is what the payment is, this is what the RTGS details are in the system. So I think that also takes out the extra load in terms of manual accounting, in terms of while dispersing the cash. So if you have a cash discount of 15 crores, you want to do one payment on your own, you can do it. That's not a problem. But if you really wanted to move this process or rather save this time, I think this solution is also being implemented.
Thanks, Yatin. Akshay, or do you want to take over? Okay, so we'll be taking the last 3 questions of the webinar. So the question. Am I audible to you guys?
Yeah.
Yeah. So we'll be taking the last 3 questions of the webinar. So the question that we have is that the vendor relationship perspective was really interesting. So do vendors also resonate with the idea of this being a solution that shows how much Zydus values suppliers?
I think that has been time and again seen through a repeat participation. If somebody comes on a day one, experiences and goes away, I think then the question comes that this is of no value. I think this is where our suppliers resonate that this is something which is available tool for them anytime they wanted to come, they want funding, they can come and make use out of it. There are no force from Zydus side that you please do this or this is something which you need to do. So it completely empowers our supplier to start looking for their support requirement. As a matter of fact, this is also some of the feedback which we received in our yearly vendor engagement. So this is something which helps them in terms of when they need some sort of funding. I think they need not have to be worried about it because they rely on Zydus supply program. This program is helping them to have the liquidity at tap. So it definitely resonates, and I think we are seeing the stronger, connection. Rather, like I said, that suppliers started using this platform as a reconciliation tool as well. So that's an interesting thing, and we started getting feedbacks. So that ensures the overall improvement in the, organization health. So
Interesting.
definitely, it does, have a, the suppliers also resonate the same way what we are seeing this.
Thanks, Yatin. So we'll be taking over the last question in the course of time. So Mr. Bakul says he joined a few minutes later. Can you please, this question is for you, Ankur. So can you please tell about what are the criteria for sanctioning limits for suppliers, sales, bill discounting? Also, the second part of this question is there any program to engage financial consultants?
Thanks, Bakul, for joining and sharing a question. So to answer your question on supplier sanctioning, there is actually no criteria as such for sanctioning limits on the supplier side. We have suppliers as small as 20 to 50 lakh turnover per annum discounting their bills. We have suppliers who are as large as 1,000 crore plus discounting their bills. The ticket size or the limit size we've seen as small as, again, 20,000 rupees going up to 10 crores plus, right? So it's actually, like we've mentioned through the webinar, it's a very flexible solution for suppliers, and it is a very broad-based solution that allows suppliers of all sizes and all industries to avail of bill discounting without having to go through tedious and onerous sanction process or documentation process. And as far as questions around engaging consultants, we do have a program for financial consultants. We can connect separately to explore.
Sure. So we'll connect with Mr. Bakul separately, and also Mr. Bakul will share the webinar recording with you and like further details to move ahead. So I think this was the last question for the webinar. And thank you, Yatin. Thank you, Ankur, for your time. This was a very insightful discussion with you both on vendor financing and its solutions. So I thank you all for your time. I would like to close the session now.
Sure.
We have done a little over time, but I think it's fine for such an insightful session.
Thank you, Radhika. Thank you so much, Yatin. This is super engaging session and great insights. So again, thanks once again, and thanks all the participants for joining in and listening in. We're happy to answer questions offline as well. Yatin, look forward to engaging and doing more such discussions with you. Always pleasure connecting. So thanks once again.
Thanks, Ankur. And we'll be definitely engaging more and more on this, program. Thank you, everyone.
Thank you, everyone who joined.